at the financial. Let's continue to look at the financial institution. We have seen a financial markets in our previous videos, which is one of the components of financial system. So now let's proceed looking at a financial institution, which is the other component of the financial system. So these financial institutions can be classified as depository and non-depository. They are institutions which provide a financial service for the customers. We have deeply looked at mutual funds, investment companies, insurances, and pension funds in our previous chapter. These are a non-depository financial institution. So let's look at about commercial banks, saving loan associations, and credit unions, which are depository financial institutions in this chapter. So the primary function of commercial banks is accepting deposits. Their primary function is accepting deposits. Mostly customer deposits are short-term liabilities for them because we do not know when people ask. So that means their liability is mostly deposits and individuals deposit, and their asset is the money they borrowed. Like think of it as an account receivable on their balance sheets. On their income statement, most of it, their revenue is a spread. What is a spread? The spread is the difference between the bank lending rate and the bank borrowing rate. So the interest they pay for the deposits and the interest they receive from the money they borrow for other person, the difference between that is their revenue, which is called a spread. For example, if the bank lending rate is 7% and the bank asks 14% for the one who borrows from this bank, the difference between this 7% and 14% is 7%, which is a spread, can be considered as a revenue or income. The other is rental income. Next to this spread, their main revenue is the rental income. If they have a big building and do not use all of it, they will rent some of the portion, some of its part, and that might be also used as an income for the institution. The other one is service fee. A bank charges some amount of service fee that might also be considered as their revenue in their income statement. They are established aimed to get a profit. As we have discussed before, demand deposit, saving account, and fixed deposit or fixed accounts are. The main risk associated in banking industry is the first one, the credit risk. A credit risk is when other people borrow from the bank but fail to return, which is known as a non-performing loan. Risks in banking, risks in general can be classified as systematic and unsystematic. The systematic risk is a risk that cannot be avoided by the company. However, unsystematic risk is a risk that can be avoided on the performance of the company. So if the company wants or works hard, it can avoid unsystematic risks while systematic risks remain. So credit risk is unsystematic risk, means that the company can avoid this kind of risk. This risk can be minimized by proper credit assessment, loan diversification, a risk management practice, and regulatory frameworks. A company should know for whom he provides the credit, so he should evaluate the credit worthiness of the borrower. This is one method of reducing non-performing loans. The other risk is a market risk, which is, so this happens to every company, not an individual. A market risk is a variability of return arising from a boom, or boom means getting up, and bear is drop of the market price that occur due to tangible force. A tangible force might be visible events like earthquake, recession, or intangible force that are a market psychology, for example, that can be created by this tangible force. For example, if let's change our attention to airplane industry. For example, if some natural accident happens to the plane, which is a tangible force, the market psychology might be changed. And for example, the accident on the Boeing airplane, this accident made the companies to drop. This kind of risk is unavoidable. considered as a systematic risk because the price of the Boeing share drops after the accident happens, and that accident is something that this company cannot avoid because it's a natural accident, which is a tangible force. With this tangible force, the market psychology taught that. For example, let me think the natural accident was a wind that made the plane to crash, but the market psychology has been changed and taught that the airplane that Boeing company made doesn't function properly, or they are not durable. Because of that, the price might drop. This is what we call the price of the share might drop. This is what we call a market risk. So in banking institutions are also some accidents which are created that makes the price to drop, the price of that institution to drop, which is uncontrollable by the company. The other one is a regulatory risk. This is when the government rules changes regarding to the function of our company. So this is the risk that the government prohibits what we are doing or what we have intended to do. So we cannot do that because the regulation has been changed and prohibits us to do. The possibility of that might occur is a regulatory risk. The other one is interest rate risk or funding risk. Interest rate risk is the variability of return arising from the change in the interest rate. As we all know, security prices and interest rates are inversely proportional. Don't worry, I will explain about this. And these risks more directly affect a bondholder rather than an equity shareholders, because bonds directly pay an interest payment and they can be directly affected by interest rate risk. Let me look at the impact. Let us look at the impact. How change in interest rate can affect the bondholder. Example, you can relate this risk with the banks because a bank can issue both bonds and equity securities. So let's say if we buy a bond with 10% interest that pays us 10% interest, I bought a bond that pays me 10% interest from one bank. So after 2 years, the market interest rate increases 12%. A market interest rate is what others are paying related to our bank. No, it doesn't mean related to our bank, but what others are paying in. So others are paying 12%. So after other companies. So after 2 years, if I want to sell my bond, after 2 years, no one wants to buy my bond that pays 10% interest, where the competitors are paying or others bond issuers are paying 12% for their bondholders. So the company I bought bond paying 10%. However, most of other companies are paying 12%, which is 2% greater than the bond that I hold. So if you are not familiar with this term bond, I have a video on that clearly specifies how debt market works. I will put the link in the description and you can click here also. So as the demand for our bond decreases because it pays 10% when others are paying 12%, so the demand for our bond will decrease. Nobody wants to buy our bond. If I wanted to sell my bond on the secondary market, the demand for that bond is low because the person who bought my bond receives 10% periodical interest rate. But if he bought that bond from other person, he might get 12%, which other companies are paying. So the demand for our bond decrease. So you can say that the impact is direct on bondholders and bigger compared with the impact on the shareholders. Let's look at the impact on the shareholders. Shareholders sells their share and buy bond instead if the interest rate of the bond is increased. This results the share price to decline. However, the impact here is indirect and small compared with the impact on the bondholder, which is direct impact. So if the investor which holds a share heard that the market interest rate has increased, which most of They don't want to continue holding that. Rather, instead, they will buy the bond by selling their shares. When most of the investors sell their shares to buy this bond, because most of the companies are paying 12%, that means the interest rates has increased and all investors want their return. With that, the demand for bond for share will decline when most of shares are sold in the market, because I will sell my share if I don't want it. As long as the interest payments of the bond is higher, why do I hold a share and why don't I buy a bond instead? This made the value of bond to decline, the demand for the bond to decline. Eventually, that affects the share price. So interest rate risk is a systematic risk because it cannot be controlled by the company. The company cannot control what other companies are paying. If most of other companies has increased their interest rates, the company cannot command or regulate them to decrease their interest rate, to lower their interest rate. He might increase the interest payments that he made. Can he do that? I will leave this question for you. Just think of it and write it in the description. Sorry, in the comment section. The other one is a liquidity risk. We have seen a credit risk in previous when a borrower fails to return. However, a liquidity risk is, in other scenarios, a liquidity risk is facing the risk of inability to change our security to cash whenever we want, either because of a thin market or any other reason. Thin market means where there is no enough market or a secondary market to change our security to cash. However, in banking industries, it's the opposite of credit risk, which is unable to pay back the client's money or deposit. The first one is when the borrower fails to return. The second one is when the bank fails to return a client's or a customer's deposit, when they cannot withdraw the money. This is unsystematic risk because it's unavoidable. The company or the bank might use different techniques in order to retain its liquidity position or the ability to pay whenever it's asked to be withdrawn, to withdraw the money. So the other one is operational risk. This is unsystematic risk, and operating risk, can, because due to the operating environment of the company, like input price. So this is not something that comes to the overall industry or the macroeconomy, and this is unique to the company itself, and it might do its best to minimize this risk. The other one is operational risk. We have seen that operating risk. The reputation risk, the probability for the company to lose its goodwill. This is how people will perceive this company. So the company can maintain this goodwill. That means it's unsystematic risk. The other one is country transfer risk or currency that can be caused due to currency fluctuation. This cannot be controlled because the company cannot or the bank cannot control the buying power of this money. It can be also called as exchange rate risk by holding, for example, if we hold foreign investment and when their dividend or interest or periodic returns come and paid with their currency, but when we translate that currency, note that it's a foreign investment, so when we receive that dividend or interest and it turns to our country's currency, when it means nothing due to the fluctuations of exchange rate. So this is also a systematic risk, which is not firm specific or company specific. It's a country specific rather. However, company specific risks are unsystematic risks. We will also have other type of risks when we get out of the banking industry. The other is country risk. So the following risks can also be considered risks that can also affect banking industries, which we haven't previously mentioned. For example, country or political risk. The risk of not investing in that country due to its political reason or political instability. This is a macro or country specific or systematic risk that happen to the overall country. Remember that a banking company can also buy a share of other companies, or it can invest its money in a debt or equity market. Okay, now let's talk about some risks that we do not have talked about from this systematic risk. So, the other is a purchasing power risk or inflation risk. This means when the money we get or the return we get from our investment, it might be in forms of interest if we borrow, or if we lend. I mean, if it might also be a dividend if we buy a share of one company, and if that return is not
Yeah.
enough to cover inflation rates. For example, I lend the money, that means I invested in, probably I might not buy any bond. Even if I lend this $100 to someone else, it can still be called an investment, because the definition of investment is any sacrification of resources. That resource might be something that is expressed in terms of monetary or any other thing. For example, time. If you spend watching a movie, you are investing your time on movies. So any sacrification of resources. A resource might be time, money, something that can be expressed in terms of monetary value, or something that might not. But when you sacrifice that resource, you should expect some future return. And regarding to the definition or to the perspective of investment, it is the expectation of future returns in the long run. So we are looking about the subject of finance. We look an investment from the perspective of monetary terms, or investing something that can be expressed in terms of monetary value rather than time and any other things. Because don't forget, the course, it is a financial market about finance. In finance is something that's related to monetary value. That's why we focus on monetary terms. So if I expect some return, if I invest this $100 by expecting some returns, for example, so if I invest this in bonds, or if I buy bond, it's called an investment. Or if I lend this money directly to someone else, it is still called an investment, because I'm expecting a return, future return. If I put this $100 to the bank, that means I'm lending to the bank as a deposit, it is still be called as an investment, because I will earn periodic interest payments. Good. So when I invest, I will expect something. For example, if the person is willing to pay 10% interest, let me think this $100 is invested in bond, and the bond pays an interest of 10%. So my expectation is the inflation rate will also be 10%. This is my expectation. Finally, I will at the end I will get the whole amount, or at the maturity period after these 2 years, the last interest payment in the maturity $100 in the same year. However, in the first year I will get 10% of interest. For the second year, I will get 10% of interest in the full maturity principal. However, a deviation has been created. That means I expected the inflation to be 10%, but it came out to be 50%. 50%. This is a risk, because the definition of risk is a chance where the expected return means that 10% that I expect the inflation to be, or I expected the return will cover all of the inflation. However, this might vary from the realized return, but my actual return is something that do not even cover the inflation. So if there is a variation between the expectation and what I get, or the realized return, because it might be because of different sources or factors, we can call these sources and factors as elements of risk, which can be broadly classified as macro and macro specific. When we say this word macro, it is a big, which is in the country specific, country wide, which is not firm specific, that we have seen till now as a systematic or elements of risk. systematic element. The other is micro, which is specific to the company, our company, which was unsystematic risk. Oh, it's 10% interest. It's too much, especially if the at the start of the agreement or when I buy the bond, if the interest is 5%, when I sign the contract, the issuer tells me that I will pay you 10% interest periodically. So I thought that this 10% is huge. However, the inflation rate grows from 5% to the next year, to in the first year, to 50%. That's too much. So this 10% interest does not cover the interest. So the interest, that is, there is no variation with your expectation of the return from the perspective of nominal rate of return. A nominal rate of return is what the issuer pays you. That means this 10%. However, the real rate of return is the nominal rate of return adjusted by inflation risk. If you subtract this nominal rate of return, which is 10% minus 50%, that negative 40% is your real rate of return. So a real rate of return shows you how much you are earning in relation with inflation growth. The inflation is growing by 50%, however your interest is fixed at 10%. But from the start you expected the real rate of returns to be 5% rather than negative 40%, because you are expecting that I will get 10% of return and the inflation remains 5%. That means 10 minus 5, you expected that I will have 5% of real rate of return. That is your expectation. However, the inflation grows by 50%, by 45%. That means the 10 minus 50, it becomes negative 40. Negative 40 is different because you are expecting 5% return, real rate of return. However, you got negative 40 real rate of return. This is a risk that we call a purchasing power or inflation risk. It's the variability of return arising from a change in inflation rate. Every rate of is a return after considering the inflation adjustment. You cannot do anything about the country's inflation rate, that is in the macro or country specific, which makes it to be categorized under systematic risk. This mostly affects other individuals rather than banks, but it still affects banks, because banks also have an investment, because we have two types of investors. One is institutional investors and the other is a retail investors or individual investor. What we haven't seen from unsystematic risks, one is a financial risk. This can affect most companies including banks because it is caused due to the financial pattern that's followed by the company, the financial pattern or the capital structure. If you don't know a capital structure, I made a video. I will put the link in the description, or you can get it from here. You can click here. That means the company might be composed of or financed from debt or equity. That means if it's financed most of its capital through debt, that means he should pay interest. If it's more financed with equity, it should pay more dividend that the investor or shareholders require. But dividend is not must. However, for example, if the interest rate is high, the dividend might be low, or the dividend that's required by the shareholders, by our shareholders, might be low. In this scenario, probably we might finance our company more through equity, because the interest rate is high, means we should pay lot of interests. However, if we found the equity cost cheap than the debt, we should finance our company through the equity. So when the company fails to manage the appropriate financial pattern or the appropriate capital structure that he should follow, probably he might get stuck, like paying too much interest. Like such kind of scenarios, such kind of risks are called financial risk, that can be caused due to the financial pattern the company follows. Business risk is inability of the company to generate income due to many reasons or internal reasons. For this, probably the company might mitigate the risk through by following the appropriate finance. The other unsystematic risk is a business risk. This risk differs from the financial risk because a financial risk is when the company obtains funds. So, however, business risk happens after the company obtains its working capital or obtains the money it needs for its operation and enters into actual operations and not be profitable, getting or not earning the profit you want. So a financial risk is probably when the company is unable to return to its financiers. Financiers means it might be for its lenders or for equity shareholders. If it has, for example, for the default that if the company is built, so in short, the company is unable to generate a return for its financiers. The return of these financiers might be an interest or dividend. However, something that you should know is an interest is paid before dividend because they have a primary they have the claim rather than the equity shareholder which have a residual. So the company might not generate enough cash even if after paying its interest the profits may be lesser, and that is a business risk which the company can can manage by working hard. That's why we call this unsystematic risk. The other risk is the credit down risk, which is the risk that credit raters might give the company a low rating. This business risk and the financial risk is also common for the banking industries are also because they are one of the companies who can invest as an institutional investor rather than an individual or retail investor. A credit down risk is when there are some credit raters. Credit raters are an agencies that evaluates the credit worthiness of a financial institution. So if those financial institutions did because of any reasons gives us a low rating, it means other investors or lenders when we sell our share, they will look at our credit rating, and if that credit rating is, for example, if it's DD, it is a low rating. For higher credit rated companies, they have A rating. AA rating, that is the highest that can be given for a credit worthy company. But if this credit raters companies considers our company as having a low credit rate or low credit worthy, this means our other investors look at our credit rating, and if it says DDD, this means the lowest. This signifies them that we have a lowest credit rate or credit worthy. We are less credit worthy. That means they will ask our company to give them a high credit rate, a high interest rate, in order to cover or to compensate the risk they are taking of buying a bond that is from a company that is considered uncreditworthy. So the risk that these credit rating companies might give us a low rating is called a credit down risk. The other one is a reinvestment risk. For example, imagine you have a bond or you bought a bond from one company. That bond pays you 5% interest, or that company pays you 5% interest for holding their bonds. And when it matures, if you cannot find another company that pays this much amount of interest, rather it pays you 3% of interest, you have reinvested this money to another company that pays you 3% interest. This resulting in low return compared with the original 5%. So this 5%, the first bond matures and you reinvest your money to another bond, but that bond pays you 3%, which is lesser than the previous 5% interest. This is a reinvestment risk. This is individual specific, which is unsystematic. It's not something that came from the whole country, but this is a firm specific or individual and probably might be managed. Also, the credit down risk can also be managed, because if you are credit worthy, you might not get this credit sound rating. Probably you might also avoid reinvestment risk that by finding the most appropriate investment that pays you a higher return. The other one is a call risk. Risk is call risk. So in order to understand call risk, you should understand what a callable and puttable securities are. When we classify financial markets based on its maturity, we have classified as money and capital market. And in capital markets, there are debt and equity instruments. Also, there are a derivative instrument, which we will see them later on. There are different types of bonds, but we will not look at them now. We will look at them in the future sessions. But now we will look at callable and puttable bonds. When we classify types of bonds based on a special right given to the one of the two parties, this is a specific type of or subtype of fixed income bonds, because there are another types of bonds which will follow a floating interest rate. This means from the start there is an agreement saying that the interest is not fixed or constant. So the issuer and the holder will agree with a variable interest. So the interest is contingent and is not known well or fixed throughout the maturity period. So the interest that the issuer pays to the holder may vary throughout that period. For the time being, if you know this, it's enough. So for fixed income bonds, that means from the start the issuer and the holders will agree to pay a specific interest rate throughout the period. It means if it's 8%, the issuer cannot increase or decrease the interest payments that pays to the holder throughout some period, specific period. That are called fixed income bonds. And these three are the subtypes of these fixed income bonds: straight or bullet, callable, and puttable bonds. So if the interest is constant, three things might happen. The first one is, let's assume in all of these three scenarios, the market interest rate, which other pays, or you can say as other bond issuers pays to their bondholders, is 8%. In all of these three scenarios, there is a probability that throughout this maturity period, let me think this as 5 years. At the start, the market interest rate was 8%, and what the issuer agrees to pay for the holder, which is a nominal interest, is also 8%. If these two interest rates keep going constant without changing, neither the issuer nor the bondholder will not be benefited or incur losses throughout the period. However, let me think, both at the start, the coupon interest rate, if this word is new to you, you can watch my videos that I made about bonds. I'll put the link in the description, or you can click it here. A coupon interest rate is what the issuer pays to the holder. So if it is 8% at the start, also the market interest rate was 8%. This means at the start there is no party that is benefited or incurs loss. However, after year 1 passes, on year 2, the market interest rate drops to 5%. This affects the issuer because the issuer should pay because it's a fixed income bond. That means the issuer should pay a fixed amount of 8% interest for all of these 5 years. This means on year 2, the issuer is paying 8% when other parties in the markets are paying 5%. So the issuer is losing and the holder is benefited from it. However, if it is a straight or bullet bond, sometimes it's called as a term bond. A term bond, this refers to any of these two parties cannot cancel the agreement until this maturity period is reached. So no one could. A term bond is a non-redeemable before its maturity. This means cannot be turned back to the issuer until this maturity period is reached. And constant interest payment on the installment. Installment base means on periodic basis, on year 1 and year 2 and year 3, in the regular repetitive interval of time. So in this bond or in term bond, no one has the right to redeem, whether the issuer or the holder. It means if the market interest rate drops, the issuer is obligated to fulfill its contract obligation, whether he is happy or not. However, this is the advantage for because he is receiving 8% interest while other investors are receiving in the market 5% interest. Also, if the interest rate goes up, the market interest rate goes up from 8% to 10%, the issuer is paying 8% when other competitors in the market are paying 10%. In this scenario, the issuer is benefiting. That makes But what if one of the two parties has the right to cancel the agreement? This kind of bond is not called as a term bond. Rather, it is called callable or puttable bond. Callable means regaining the bond. Who can regain the bond? That's the issuer, or is calling back the bond from where it is sold. This signifies that the right is exercised by the issuer. So in the agreement from the start, they will agree that the issuer has a right to cancel the agreement if he wants to. Probably this right might be exercised when the issuer is not happy on the interest he pays on for the holder. And from the previous scenario, this will happen when the interest rate falls, the market interest rate falls, because the issuer wants to redeem the bond or buy the bond he sold before and gets his bond back to sell for other bondholder or for other investor at 5% rather than paying this 8% for this original bondholder. So the issuer can give the money he borrowed and take his bond back after or beyond a specific predetermined date before a maturity. So this is mostly exercised when the market interest rate falls, as we have discussed, but he is paying, or the issuer is paying, additional interest, in this case which is 3%, due to his previous bond contract agreement. And the specific predetermined price, the price of calling back, will be determined from the start in the bond agreement. So if the issuer wants to cancel, he should pay something, but he has the right to cancel the agreement, unlike the term bond. The puttable bond, so redeemable means regaining your bond back from the issuer perspective. The other one is a puttable bond. This time the holder has the right to return, or you can think of it in this way: returning the bond. Returning the bond is putting back the bond from where you took from or bought. When you see from the holder's perspective, if you are a holder, you took the bond and put it back to the issuer. In puttable bond, the holder has the right to return or put the bond and take his money back beyond the specified dates or maturity. This will be exercised by the holder when the market interest rate is up or down, when the market interest rate increases, because the holder is receiving 8% at this point from the issuer in a fixed income bond that is paid, or that is in puttable bond. The holder has the right to return or put the bond and take his money back beyond the specified dates or maturity. This will be exercised by the holder when the market interest rate is up or down, when the market interest rate increases, because the holder is receiving 8% at this point from the issuer in a fixed income bond that is paid, or that is fixed on the coupon interest rate at the start. This 8% not sufficient enough when compared with 10% that others issuers are paying in the market for their bondholder. So the holder wants to return back put back the bond to the issuer and buy another security or another bond in the market to get 10% return rather than continuing to get 8% from this issuer. This option is mostly exercised by the holder when the market interest rates increases. So now you are ready to understand this call risk. Suppose you own a bond that pays 6% interest, but the issuer decided to call the bond and repay you early when the interest rate has dropped to 4%. As we have said, when the market interest rate drops, the issuer exercises power. This forces you to reinvest the money at the low rates in the market at 4% rather than receiving. If it is term bond, you will continue to receive 6% from the issuer, whether the issuer is happy or not. But in the callable bond, if he cancels the agreement and the market is paying lesser than what the coupon interest rate states or the issuer pays you, this means you will reinvest back to the market, and that market pays you a lower interest rate from the original. This is a call risk that reduces your income compared with the previous that you are getting from the issuer. This is unsystematic risk because this is firm specific or individual company specific, because you can buy and avoid this risk by using term bonds rather than callable bonds. You deliberately took the risk and give the issuer the right to cancel your agreement. This is unsystematic risk. That's why we classify as unsystematic risk. This might also affect bankers as one investors, as one institutional investor. So the risks that we have been talking are not only linked to the banking industry, but they might also affect other institutions. All of these risks affect not only the banking industry but other institutions and individuals investors also. There are risks that can be faced by any party that is involving in investment and providing financial services like a banking industry. And some of them affect as individual levels, or some of them affect as country level. So let's return to our previous topic in the financial institutions. We have seen a lot of risk in the banking industry. So something that we should know is commercial bank is something that can be used by everyone, even sometimes internationally or at a global level. They are established for having a profit, so their profitability is most likely to be high, and their customer can get a service like loan, saving, or depositing. There are a lot of other services that can be given by commercial bank to their customers that require service charges for the customers. Depository financial institution can be banks or non-bank thrift institutions. Non-bank thrift institutions are like saving banks, saving loan associations, and credit unions. Other services that can be given by commercial banks include like issuing a letter of credit. Letter of credit is a document that is given by the banks to its customers when he found them they are creditworthy, and think of it as a certificate that's showing that individual is a creditworthy person. So this letter of credit is issued by banks. In some countries, when there is no a custodian bank is, think of it as a locker. It's a bank that gives you a safekeeping service for your commodity. If you have, there are expensive commodities like gold, a diamond, you can safekeep them in this custodian bank. But in some countries, when there is no custodian bank, they might also perform this job on behalf of custodian bank. Not on behalf, but like a custodian bank when there is no custodian bank in the country. It's not free service, they always charge. They took service charge. They can also buy a short-term treasury bills that are issued by the government. This is an investing activity that makes the country grow. This kind of service are considered as a secondary functions of a commercial bank rather than a primary function. But the primary function of commercial bank is accepting deposit and providing loan, and use the spread as a main revenue or income, like we have discussed in the previous videos. The loan might not be only given in a direct or usual way, but there are different types of loans. For example, there is overdraft facility that is provided by commercial banks. This include this is mostly given by loyal customers of the bank most of the time. For example, if you have a check that have a money $120 inside, this means your balance is 120, but you want to make a payment of $150, so you need additional $30. So when you sign the check, the bank allows you to draw $30 more than you have in account, and you can make the payment. However, this is a liability for you. In the future, you will pay this $30 for the bank. This is why it's called overdraft. You can draw over than what is in your account. You can sign a check more than what your check balance has. and settle your liability later on. They can also give interbank loan when one bank provides a loan for the other bank rather than in individuals. This commercial bank can give consumer loans. They have a potential, but most of the time they do not give. Even if they do, they are the banks, the kind of banks that engage. I mean, if they have a high financial sustainability, otherwise they do not focus on giving a consumer loan. Rather, they give a business loan or a commercial loan, mostly for corporations than giving for individuals or for real estate firms. Mostly they will give a commercial loan or real estate loan rather than giving a consumer loan. Even if they give for the consumer, they probably might give for their employees and other kind of people that relate to the institution. So that's why these non-bank thrift institutions are introduced. They will focus on consumer loans most of the time, unlike the commercial banks. So let me start with saving and loan association, and I will continue these two topics later on. So saving and loan associations are the one who focuses on consumer loan, saving loan associations. So when they provide loan, their collateral, most of the time people borrow from saving and loan associations to buy something, and if they bought something using this saving loan associations money, that equipment is considered as a collateral, and if the borrower unable to pay the debt, this institution will take that equipment. They can be formed in two ways. They can be a mutually owned, or means by pooling money from different members. So they have a member. This time they provide the loan only for their members. However, if they are publicly established rather than mutually owned, this time they will trade their shares and will be established, and after that everyone can use. Probably it's not internationally, but like the commercial bank may not include that kind of service, but are small. This time anyone can use this. Just think of them as a banks, a commercial banks, but in a smaller size if they are publicly owned. But if they are mutually owned, have a members, and the loan is given only for the members, not for the public. However, if they are publicly owned or by selling their shares, it's for the public itself, and anyone can use them. Their profitability is a bit higher, and they focus on giving a long term. They are depository institutions. Think of them as small banks. The other one is saving bank. Saving bank this can also be mutually established or publicly traded. So if they sell their shares, they are publicly traded. Mostly they are the one who brought service for individuals, and their profitability depends on the size of members and their capital. So you can easily differentiate saving in loan association from saving banks with this word. Both of them have a saving. However, this one has a loan. Means that saving in loan association promote both saving and giving loan. It offers this service. However, saving banks will offer saving only. So they do not borrow. I mean, they do not lend you the money, but they promote saving only. And they invest your money, and after investing your money, they will try to give you adequate return. So you cannot borrow from them. However, the money that you put or you deposited in this saving, sorry for the word dividend here. They invest your money and gives you an interest, like what the commercial banks gives you. After investing your money, they will try to survive by being profitable in the investment rather than commercial banks. What a commercial bank is doing, because commercial banks are profitable using that spread. That is the difference between the bank lending rate and the bank borrowing rate. That's their main profit. However, saving banks do not give lending services, so they do not have a spread. However, they can take your money and invest it, and the return on their investment will help us to survive and give you the interest. That's why we call them as a depository. The other one is the credit union. This is mostly for the employees in one company operates and has many different employees. It may not only be a business company, but under any institution there might be a credit union. Mostly the service their employees. This means they have a limited group, like employees in the association. Hence, they are established and serve a limited group. Mostly, they are small compared with other depository institutions, and are non-profit organizations established by its members. So their profitability is compared with others. Most of the time, they lend money with a borrowing rate. That means they do not have that much of spread. They all established to serve the employees, and they are unique and have a common bond. For example, in the organization, there might be a credit union that is established only for some individual employee. Not individual, but for some kind of group in the institution. Now we have seen all that. So now we have seen all of the depository financial institutions and non-depository financial institutions. But from non-depository financial institutions, but there is something that we haven't seen in the pension funds. Pension funds has a contribution. That means the money that these pension funds collect from employees, and the benefit or the return that these pension funds pay back to these employees. So sometimes the amount of contribution is unknown, and sometimes the amount of the benefit is unknown. Let's look everything from the perspective of contribution is what they give for the pension fund, and the benefit is what they receive from the pension fund. When this contribution is known, this means the benefit might not be known, or the benefit is unknown. This is called the defined contribution, because the contribution is known. However, the benefit depends on the future profitability of the pension funds. The second one is a defined benefit. That means the benefits these employees get in the future is known or predetermined. However, you cannot say that the contribution is unknown, because the contribution is what we make now. However, the return or the benefit is what comes from in the future. The future is uncertain. That's why in defined contribution, the benefit is something that depends on the future profitability. However, when the pension fund guarantees a fixed benefit, or the company or the pension fund guaranteed a fixed known rate of return, known return, whether it becomes profitable or not, the future, we call it as defined benefit. That means the benefit is known, also the contribution is known. There is no probability that what the employee pays is considered unknown, because he gets his salary. As long as he gets his salary, it's possible to some fixed amount of money from that salary. So there is no possibility the contribution might be unknown. However, when the money gets into the pension fund, they should invest that money. Most of the time, they invest as a retirement scheme. They invest in treasury bill and risk-free assets most of the time, because they hold other people, so they shouldn't engage in risky investments. The third one is hybrid. As we all know, always the contribution is known. However, in the benefits, the company promises some fixed amount, which has one character of a defined benefit. Also, if the company or if the pension fund is profitable, he will add more. This contains a defined contribution. That means hybrid is merging these two pension plans. So with this, we conclude our discussion on financial institutions after looking the financial market. And both of financial market and financial institutions are the components of financial. So we're gonna proceed to discuss about the financial regulation in us, and after that we will conclude our discussion on this course. When you look at the financial assets, don't consider this. In fact, they are financial assets, but we will look this money market and capital market instrument just to talk about the market, not the asset. And in fact, we have discussed about the assets to tell you that these assets are sold in this market. So now it's time to look at different financial assets and the regulation in future sessions. So more or less we have discussed about money market instruments. So we look at the capital market instruments, that is debt instruments, long-term debt instruments, equity instruments, and derivatives. From the start, we have discussed about what financial assets are. Most of the time, they are contract. They can be also cash is also considered as a financial asset, and physical currencies, short bank deposits. These are also an assets. Remember this picture? So we have seen most of the money market instruments. In the capital market, let me start from the bond. I've seen the bond types based on a special given to the issuer or the holder, or neither, for both, neither of them. The other one is classifying a bond based on the interest payment. We have looked at this also, zero coupon bonds and interest bearing bonds. Zero coupon bonds are bonds that are sold from the issuer perspective or bought from the holder perspective with the from the discount, and maturities with the face value. They mature with the face value specified date, so you will not sell or you cannot sell for the third party or reinvest it after receiving the money by selling for the third party, because if you did, you will less likely to be profitable from it, because they do not have a specified interest, because you can't get a return from interest rate fluctuation between the market and the coupon interest rate. Hence, no interest is paid for this kind of bonds. This will mostly reduce reinvestment risk. However, interest-bearing bonds are, as stated, interest rates written on